Imagine waking up one morning to headlines screaming that a safe bank one praised for innovation, discipline, and smart risk management has just been wiped out, not hacked, not robbed, simply liquidated. Overnight, depositors locked out, executives silent, regulators scrambling. Now here's the uncomfortable question most people avoid. If banks are supposed to be boring, stable, and protected, how does something like this even happen? And more importantly, why does it keep happening again and again under different names, different decades, different excuses? Today's story is about that mystery. It's about Silver Spike, a bank that rose quietly, earned trust methodically, and then collapsed in a way that shocked even seasoned insiders. But this isn't just about one bank. It's about a system that keeps repeating the same pattern, and why the warning signs are always there long before the failure. To understand how Silver Spike got liquidated, we have to rewind. Not to the day it failed, but to the financial environment that made its rise possible in the first place. For years, the global banking system has operated on a fragile promise: confidence. Banks don't actually keep most of your money. They lend it, invest it, and reuse it, assuming not everyone will ask for it back at once. This works beautifully in calm times. It collapses brutally in stress. Silver Spike was born in one of those calm periods. Low interest rates, cheap liquidity, investors hungry for yield. Regulators relaxed after years without a major crisis in that sector. It positioned itself as a modern institution, data-driven, tech-savvy, disciplined. It didn't chase reckless retail loans. It didn't gamble openly in exotic markets. Instead, it focused on what looked like a smart niche: concentrated, high-value clients, structured assets, and supposedly low-risk returns. Early on, the strategy worked. Assets grew. Deposits poured in. Analysts praised its balance sheet efficiency. Silver Spike became a favorite example of new banking done right. Quiet growth, minimal drama, strong quarterly reports. But underneath that calm surface, a subtle imbalance was forming. Silver Spike's origins contained the seed of its downfall. To grow faster than traditional banks, it relied heavily on large, uninsured deposits, corporate funds, institutional money, wealthy clients who could move millions with a click. This gave the bank flexibility and scale, but it also created fragility. Unlike retail customers, these depositors don't wait in line. They leave instantly at the first sign of trouble. At the same time, Silver Spike invested a significant portion of its funds into long-duration assets. Bonds, structured products, and interest rate-sensitive instruments that looked safe as long as rates stayed low. On paper, these assets were high quality. In reality, they were highly exposed to one assumption: stability. For a while, nothing broke. Profits rose. Executives doubled down. Risk models based on historical calm showed no red flags. This is where the rise turns dangerous. Success begins to feel like proof of correctness. Then the environment changed. Interest rates started rising faster than anyone expected. What had once been safe became volatile. Bond prices fell. Unrealized losses quietly accumulated on Silver Spike's balance sheet. But because these losses weren't immediately realized, they stayed hidden in plain sight. This is where cause and effect begins to accelerate. As rates climbed, alternative investments became more attractive. Clients began moving money not because they feared Silver Spike, but because they could earn more elsewhere. Outflows started slowly, then faster. To meet withdrawals, the bank needed liquidity. That's when the breaking point arrived. To raise cash, Silver Spike had to sell assets. But selling meant locking in losses. Losses reduced capital. Reduced capital scared depositors. Scared depositors withdrew more money. The feedback loop tightened. What turned stress into collapse wasn't a single bad decision, it was timing. A rumor here, a delayed disclosure there. A regulatory filing that revealed more losses than expected. Confidence cracked. Once confidence cracks in banking, it doesn't heal, it shatters. Within days, withdrawal requests overwhelmed liquidity buffers. Emergency funding options narrowed. Counterparties hesitated. The market, sensing blood, priced Silver Spike's debt as distressed. At this point, the bank was no longer fighting a balance sheet problem. It was fighting time. Regulators stepped in, attempting stabilization. Assurances were made. Statements released. Lines of credit discussed. But words can't replace cash, and promises can't reverse panic. When the numbers finally surfaced in full, the truth became unavoidable. Silver Spike was insolvent under realistic conditions. The assets that were supposed to mature safely over time could not cover immediate liabilities. The bank didn't just have a liquidity issue. It had a solvency problem disguised as patience. Liquidation followed. Depositors were frozen. Equity holders wiped out, executives removed. A bank that had taken years to build collapsed in a matter of hours. But the story doesn't end there. Because the aftermath matters more than the failure itself. Authorities tried damage control. Portions of the bank were sold, certain depositors were protected. Others weren't. Rules were bent in the name of systemic stability. The message was clear. Even if unspoken, some failures are too dangerous to handle cleanly. And yet none of the fixes addressed the root cause. Because Silver Spike wasn't an anomaly. It was a case study. Look around today and the parallels are unsettling. Banks still rely on confidence more than cash. Interest rate risk is still underestimated during long calm periods. Concentrated deposits are still treated as efficient, not dangerous. And unrealized losses are still waved away as temporary until they suddenly aren't. The shocking data point most people miss is this. Across the system, trillions in assets are still priced on assumptions from a different interest rate world. The math only works if time is generous and confidence is constant. History shows neither ever is. Every cycle follows the same pattern.